Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Gina Domanig, Managing Partner at Emerald. Gina, could you take a few minutes to share your story and how you got to where you are today?
Thanks for the invitation, Nicola. It's perhaps important to note that although I've been doing this for 22 years, I did have a life prior to Emerald, and I was actually working at a large Swiss industrial technology company for 10 years, running strategy and M&A. I started up what is today Emerald. I came in with a view that there was really an important relationship there between startups and corporates that needed to be fostered. So right from the very beginning, Emerald had corporates as part of our LP base. And over the years, it just became more and more clear to us that was an area that we wanted to focus on. So since 2006, 2012-ish, we've had mainly corporates. And obviously, as we tell large portfolio companies, decide who your target customer group is, align your strategy, your processes, and your resources to have the strongest value proposition. So that's how we got into it, and that's why we ended up really focusing on working with corporates. We started out being sustainability focused because I had come from industrial technology. We decided quite quickly to focus on the industrial sectors, and so that was clear already from the beginning. What was the challenge? The underlying hypothesis of Emerald from the very beginning is that the sustainability trends are going to create a lot of challenges, but also a lot of opportunities for the industrial corporations. And we want to be basically an accelerator, enable the transition for those corporates. And it's actually, to tell you the truth, it's just a lot of fun working with the corporates. We gain a lot from them. As individuals, and our portfolio companies can gain a lot by working with them. And obviously, they're not just interested in the financial returns, but they're also interested in the strategic relationships that come out of that collaboration. So for us, it was a pretty easy choice to decide to focus on working almost exclusively with corporates.
Maybe I should give huge credits to Emerald, because my first training on corporate venturing, that was January 2019, I had Marcus from your team talking and training about corporate venturing. And first, Marcus is amazing, but two, it was my first experience. And I still remember how he talked about your limited partners and the entrepreneurs and looking at both as how do you add value to both. It's not one or the other. It's not a forced choice of choosing one or the other, but bringing value to both. And I'm sure, like you mentioned, strategic value, financial value, same thing. It's not a forced choice of one or the other.
It's both.
So maybe we start with that. How do you react when people say, are you strategic or are you financial?
Yeah, that's a good point, right? I think for us as a venture capital team, we need to generate really attractive financial returns. Otherwise, we don't have a reason to continue to exist. But irrespective of those financial returns, if our corporate LPs don't achieve the strategic impact on their business, they will consider the relationship a failure, right? Even because we're dealing with the corporate development guys, the CTO's office. If they've got a CVC, we're working with the CVC guys. Right. So their mandate isn't go out and find great investment opportunities. They've got a treasury department that's responsible for that. They're really looking to move the needle on their business, right? So that's very important that we always have that in mind, that we need to generate financial returns as a firm, and we've chosen to work with a certain customer group or segment that has additional goals as well. So with each one of our LPs, actually, we agree on KPIs. And we review those KPIs every 6 months. And they have a lot to do with knowledge transfer. Some of them have actually goals to make co-investments. Others have goals to acquisitions. joint development agreements. So there's many different ways that the corporates are looking to engage with those startups. And it also changes over time, right? So I think that that's important, that we have a system in place that makes sure that we're achieving both of those goals simultaneously.
I think that's the first golden nugget, and I want to double click on it because you're talking about process, but you also have a platform for the limited partners to have access to information. So let's start with the process. How do you onboard limited partners? How do you define these discussions around KPIs? How do you follow through on these KPIs? And how do you shape your team to deliver on that?
Right. Yeah, so that's a really good point, because we believe that the process will drive, or let's say you could also have design failure, right, by having the wrong process or having a lack of a process. Sure. And we really shouldn't leave this just up to luck, if you like. So we have a very clear onboarding process where we sit with the people from our team. We always have a partner in one of the sector specialists in our team who are assigned to work with a particular corporate investor. And we sit down together and we try to understand what their strategic priorities are. What do they as a team, also, again, sometimes we're working with the CVC team. So what are their KPIs, and which one of those KPIs can we make a contribution towards achieving? And then we agree on what our KPIs should be out of that. And then we've got monthly calls. So as we've got a IT platform for our LPs to access the deals that we review. We're reviewing about 2,000 deals a year. We have 3-page write-ups on each one of those companies. So besides the corporates being able to tap into that and to extract information from that, we've got a monthly call with each one of them individually to talk about specific areas of interest from them, or specifically about some of these startups, right? And so that kind of kicks off a whole process about engaging them with particular startups. And the interesting thing is, it's irrespective of whether we're interested in investing in that company or not, right? Because just because we think a company is overvalued or they have a really capital-intensive business model that we don't really want to invest in, it doesn't mean that it's not the perfect counterpart for our corporate investors. So it's important that we also spend time, that's why we have such a large team, right? We spend time reviewing deals that could be of strategic interest to our corporates. So we've got those monthly engagement, and then every 6 months we have a sit down with our investors individually to talk about the KPIs, also to find out what has changed on their side, right? Because these are very long-term relationships, and their strategic interests and their internal goals and also restrictions will change over time. So we've got that process, and of course, twice a year we have our investor forum anyway, so we're going to meet there as well. So I think it is important, if one chooses to focus on working with corporates, that you also have, like I said before, the processes in place to ensure, also if there's a change on the corporate side, that somebody new doesn't come in and go, okay, so what have you done for me lately? We can easily pull out a sheet and say, this is what was agreed and this is what we delivered, and we can not have, if you like, a gap in the relationship.
I think there's a golden nugget you just mentioned, which is the strategic value is not limited to the portfolio companies, the companies you decide to invest. It's all the startups you're looking into a space and what you learn from them, and some could be good engagements. Also, you're not a typical VC because you have so many entrepreneurs, and these entrepreneurs should talk with you, because even if you don't invest, you can still plug them into different corporations. Do you have an investment committee where?
Yeah, so we have an investment committee, right? So in an investment committee changes composition depending on sector. So for example, if it's one of the energy deals, then we've got one of our partners, Crystal Fry, who's kind of the energy specialist. He's the one who heads up our energy fund as well. So he will then join, if you like, the core investment committee, which is Marcus, as you mentioned before, Hans, Charles, and myself. So the investment committee has different, there's different gating points, right? So first, obviously, the sector specialist brings it to the attention of the team. The investment committee decides, is this something we want to put together a deal team on to investigate more? And then that deal team will go off, and then they have quite a bit of freedom, if you like, to also to stop working on a deal, to say, look, we found certain things that make this no longer that attractive as we originally thought. And then it culminates in what we kind of erroneously call a preliminary assessment, which is actually about a 70 to 80 page document. Very preliminary. But you know, we are located in Switzerland, so we're very thorough and very accurate about everything. And that's really the key investment document and the key investment decision. And that's one thing that's also maybe a little bit different. It's typically only after that do we issue a term sheet. So we don't really appreciate this trend, if you like, of VCs to lock up deals very early in the process, get these startups into exclusivity when the VC themselves is not really sure whether they want to invest in that company. And it's unfortunate because I think a lot of times the startup companies are pushing the VCs to issue term sheets very early. But all they're doing is they're asking for a kind of a lower quality commitment disguised as a term sheet, right? Because the VC, just because they issued a term sheet, it's not going to make that big of a difference as far as whether they're going to ultimately decide to invest or not. So we try to encourage the startups to wait until we really are sure. If something passes a preliminary assessment within our process, we're 95% sure we're going to make this investment. It would really just be something maybe during, if there needs to be an additional patent review or legal due diligence, something really unexpected happening at the last minute that would cause us to not proceed. We also work in sometimes a competitive market, so we do need to adjust a little bit if we realize that it's a really interesting company. They're demanding a term sheet. We just try to make it clear to them that this is a little bit too early for us, but we'll do it.
It's a golden nugget for the entrepreneurs who are listening to us now, which is clearly you want the term sheet to come in, and you probably want term sheet to come in so that you can trigger other term sheets, but you want quality term sheets from VCs that are committed and they know they actually want to follow through. And trying to push too hard for a term sheet too quickly probably doesn't serve you well. How do you think about syndicate and help the startups be successful as a consequence?
I think there is a certain comfort in numbers, right? So I think having at least 3/4 good syndicate members is important because you just don't know. It could be one of our fantastic corporate CVCs that we've made tons of co-investments with. They get a change in CEO, the new CEO comes in, hates corporate venturing, or who knows what could happen. So I think it is important that there's enough, number-wise, enough people at the table that we can survive one of them dropping out unexpectedly, right? So I think that's one thing. The other thing is, maybe we're in a luxury situation to say this, but invest with people you know. That's the best way to get to know if somebody's a strong syndicate partner, is if you've done an investment with them in the past and you've seen how they operate. And I think people should not be hesitant to ask questions. Do some due diligence on your co-investors. If somebody is going to invest with Emerald, they should ask us, how much money do you have? Where are you in your investment cycle? How do you guys take your decisions? The startups should ask that, although I think a lot of startups will actually understand the consequences of some of the answers. But it should really be the other VCs that are either already invested in the company or joining the syndicate, who are very, let's say, frank and open with each other. And if somebody says, hey, look, I've got a 35 million fund, this is the last year of our investment period, okay, then I don't think it's a really good idea that you take 5 million in this round. Maybe you should only take 1 million and try to manage the risk already before the the investment actually starts. So I think that's what I would also say. People who are dedicated to the sector is also extremely important. I alluded to it with mentioning the generalist funds, right? But if we're co-investing with a big automotive company in a mobility startup, it's highly unlikely that they're going to change their strategy away from mobility, right? So having, whether it's the corporate VCs or the independent VCs, but having a confidence that they truly are committed to the strategy is important.
It's back to what you were saying earlier about specialized team and sector specialist. So how do you think about single GP funds? Because they are arguably specialized because of their passion, but do they really bring a good syndicate? How do you think about them?
So
and maybe it's more common in the US where you have typically partnership with multiple GP and they all make decision as a partner.
I've never worked in that situation, so it's always a risk when it's one person. Again, I like comfort in numbers. In even our investment process, I can actually get outvoted, right? A lot of people are surprised when I say that, but I don't know everything. And if there's 5 people on the investment committee, and my other 4 colleagues are super excited about this, and I have a concern, and I'm the minority, I can get outvoted. So I do think that a firm can be more consistent, and also for the outside world to understand who they are. I think it's better. Some corporates are set up like that though as well, where there's really one person who takes the decision. So it's not just a phenomena that's with the independent VCs. I think any firm which is dependent upon one person's opinion, I think has a higher risk and is not as predictable, if you like, as if it was a committee that's taking the decision. Although the committee needs to be able to act quickly. That's the great thing about kind of these single decision maker setups, is that usually the decision can be made very quickly. And I think independent VCs like us, who have multiple people on the investment committee, everybody has a very clear understanding that we must be able to take decisions within a 24-hour period. And I think the corporates, that's also something that we impress upon them when they're setting up their CVC, to make sure that investment committee realizes kind of the sense of urgency. Going back to the issue about a startup company needing an emergency rescue round, right? We can't wait until the next board meeting next quarter, right? It really needs to be a decision taken. And maybe even those corporates should delegate the authority to their CVC team to make follow-on investments up to a certain amount, right? So that they can act very quickly.
That's golden nugget again. And I think the follow authority is a good one, because at that point it's much more about financial, strategic. I also really like your point about outvoted. So at TDK Ventures, by design, I don't have a veto right. And the way, that's what you said, is don't have the veto right. If other people who are so passionate, so research, believe it should be done, you should give them the chance to go and make the case.
Exactly. In the end of the day, we're all trying to take the best decisions, right? And none of us have a crystal ball. And we're very consensus oriented within Emerald, but somebody can be outvoted, which I think is important. But once we've taken a decision, we're all in it together. Our carried structure is like that. Everything is, and we even have cases where we will change partner on a particular portfolio company because either because of the simple amount of work that's involved, so it could be a workload issue. It could also be that now the company is going into a different phase and there's a better, a more suitable partner within our firm to then be on the board of that company. So we're very team oriented. And I think that's also a reason why we've been around for so long.
In a way, you're describing a disagree and commit.
Yeah, exactly.
I really like that. But also venture capital is about being right a little early when it's not yet obvious.
Exactly. Although, one of our claims to fame is that in one of our early funds, we made 2 investments in wave technology, and we're still waiting for that to happen. So being too early can also be costly, right?
I think you need to be a little too early, so it's just in time for the next round of financing, maybe, but not 10 years early. Now, there's one thing I love, which is about decision-making science. And I wonder if you have tracked some statistics about the best investments, were they from the one where everyone agreed on the investment, or were they from the one where there was a disagreement and someone was outvoted?
It's interesting. I actually intentionally don't go back and look to see how people voted. I don't want to kind of create a finger pointing. We know each other really well, right? So Hans, Marcus, Charles, and I, we've been working together for 20 years, right? We all know each other's sensitivities. We all know what's your hot point and what type of deals do you actually really, what kinds do I really like. And it's important that we're in sync enough, right, that we can take good decisions, but it doesn't mean we always have to be of the same opinion. But yeah, to get back to your question, no, I have not gone back. What we do go back, though, is we see why were we wrong on projections, right? So you'll always be wrong, right? By definition, you'll be wrong, but to be dramatically wrong, right? So what was it, what assumption were we taking about a particular industry, a particular technology, a particular management team where we were really off? Right? Because that's a learning opportunity. And we have definitely a very strong culture of continuous improvement in learning. And so we do very judiciously go back and do reviews of every one of our investments, look to see what went right, what went wrong, and what can we pull out of that for as best practices for the entire team to learn from our experience. Because, we're 50 people now. We definitely don't want people to be repeating mistakes that I have already paid dearly for personally, and the fund is paid for. But I think that's important, that we're very transparent, that we do take that time to reflect. Again, not from a finger pointing, but from a learning exercise, and bring that to the rest of the team so that they can benefit from that experience as well.
And when you mention really off, you mean really off negatively, but also an upside? Or
exactly. It could be something that's just absolute. Believe me, we've had also very bizarre positive surprises over the years. And just to understand, how did that happen? What did we fail to see? And one of our portfolio companies, I remember we ended up selling it within, what was it, maybe 14 months, something like that. I didn't even have time to implement the ESOP by then. And we sold it for 9 to 10 times our money. We definitely didn't expect that to happen, right? What did we learn out of that, right? What industry trend did we underestimate? What competitive tension amongst the incumbents did we underestimate? I think all of those are really interesting learnings that then we can apply for our future investments.
I think that's very impressive. And it's a golden nugget again, because especially when we look at FTX, okay? It's so easy not to look at the startups that do very well. And we are like, oh yeah, we were great. And we don't even try to understand what's happening. And we focus on the ones that are not doing well. And I'm very impressed you're doing both. Thank you, Gina. This was an amazing interview with you, with so many golden nuggets and some wisdom. So thank you so much.
Great. Thank you, Nicola. I appreciate it.